Hello and welcome back to our discussion on sources of finance. In this presentation, we'll see some of the important sources of finance without getting into the details of the features of each source of finance. So we're just trying to understand all, but later on we will pick up the relevant source depending on the requirement, the nature of the business, size of the business. Because to a large extent, the sources are many. So you have to tailor the source as per your business and your personal need. So let me first present a bouquet of sources. Self-source. The first thing that a startup entrepreneur should explore is his own or her own money available. Because you should have that much of conviction to use the money that you have in the business. So explore your own sources. Then you try to tap into the pockets of your friends and relatives. So it is necessary that you should be in a position to convince your friends and relatives about the strength of the project that you are planning to take up. So the friends and relatives may chip in some amount of money provided they're convinced about your project. However, don't try to tap into friends and relatives if they are not convinced about the project. Don't take money just for the sake of taking money. The other one, which is popular, is a crowd funding or a crowd sourcing. In fact, crowdsourcing is an innovative method of raising funds. And this has been possible because of the technology today. So crowdfunding is raising of funds from multiple investors through a web-based platform or social networking platform for a specific project or mostly for some social cause. So there are lots of regulations around that. SEBI itself has come out with some regulation on that. We will get into those at the later part of our discussions. Otherwise, crowdsourcing can be an useful way of sharing your project with different stakeholders. And some of the very common ways of crowdfunding can be called as a peer-to-peer lending. Or it may be by creating some reward against lending. So there are different ways in which crowd can be tapped. Here, crowd conveys that you are tapping multiple investors through the technology. So they don't know you in person, but they will try to understand the strength of the project and fund them. Then the next one is an angel. Angel investors are actually a class of well-to-do investors who take equity stakes in the startup. There may be HNIs or professionals who have some surplus and would not like to invest in a conventional businesses, but would like to support a cause or a very innovative project. But it's more confidence building exercise is needed. Though there is a formal market network of angels, but angel funding is also an important way in which a new enterprise with a good proposal, with some innovativeness or social implication can tap in. Venture capitalists. Venture capital provides funds to the new and promising companies that are typically knowledge-based or technology-based, and they assume very high risk and they expect high returns. And normally they are not passive investors. They may be participating in the management too. And they look for a project with high involvement of technology and high risk simultaneously, or rather because of that they expect high return. So venture capitalists is also another source of fund, but which requires meticulous planning to attract the attention of venture capitalists. Conventional sources, which you just walk into a bank, convince the manager about the strength of your business proposal, tap into the normal schemes and map your project with those schemes, and who knows, the banker may lend following the usual conditions of the bank lending. At a later stage, the capital market may be an option. In early stage, at a startup stage, one may not or cannot get into the capital market, but as you grow, the capital market is raising money, both debt and equity through the capital market is another option. So here I tried to just present a bird's eye view of the entire bouquet of sources. But as we move along, we'll pick up each one of them and try to understand each source with more details and examine the legal and regulatory aspect of those funds too. But whatever is the source, whether self or venture capitalists or banks or capital market, all these sources can be clubbed into two broad categories. They're called owner's money or outsider's money, equity or debt. And this is a classic classification. In case of owner's money, the investor will have a claim on the assets, ownership claim. They have a right to participate in the profit distribution, and that is dividend. And they are called the risk takers. Whereas the liabilities or the debt giver, they don't have ownership. They have no right to participate in the profit distribution. And they get the right to of interest and the return of principal. So this is a very important decision, even at the startup. Should I take money from someone as owner's money or a liability? The decision of own money or a liability will have an impact on the profitability. But for the time being, at this juncture, I would like to leave you with this bouquet just to get a feel of various sources and reflect on the fact that all these sources can be classified or put into two baskets. One is an owner's claim, the outsider's claim. Thank you very much.